Welcome to Subramani. Who do you think determines interest rates, right? So I'm trying to do a series of talks on interest rates. So this could be one of the earlier ones. Who determines interest rates is a question which most students don't seem to be understanding completely. So let's break the first myth. It is the RBI which determines interest rates. True, only at the short end, right? So RBI can decide what will be the overnight call market, right? Which is just one day, which is mainly for bankers to borrow and lend, right? They can determine even the GSEC interest rate because they keep issuing bonds. Now this is information for you. If they issue a 30-year bond at let's say 7%, the indication is okay, in the long run interest rates have not fallen. The long run interest rate is 7%. Now if the RBI gets more ambitious and issues a 5% 30-year bond, maybe there will be no subscribers, so they will have to be careful. So RBI is telling you what will be the overnight interest rates, it is telling you what is the GSEC rate, and it is telling you what is the 30-year rate. But the price is not determined by them. If they decide to do a 5% short term, 5% 10-year and a 5% 30-year, there's a very good chance that the 5% short term will get subscribed, right? Say 90-day bill will get subscribed at 5%, but the 30-year may not get subscribed at all. Maybe no banker will touch it, right? So largely interest rates are determined by demand and supply, like everything else. So why does the share price of a company go up? Share price of a company goes up because there is demand for it. That is exactly what happens. Now suppose interest rates are very low. Is it a great time for you to be borrowing money and buy a house? Well, that's what the RBI thinks. Is it a great money for a businessman or a businesswoman to borrow money and do their business? I don't think it is so simple, right? A business person will do this only when they are confident that they will have higher income from their business. I have to be sure that my plane will be full before I buy a plane or hire a plane. It has got nothing to do with interest rates. In fact, during in such low interest rates, the people panic and they do the reverse of what Reserve Bank of India thinks. So in the long run, and in the short run, may not be in the very short run, may not be over 3 days and 4 days, but definitely even in 6 months to 1 year to 5 years and 10 years, the determination of interest rate is done by the market. The market decides at what price it will borrow and at what price it will not borrow. The businessman decides, or the businesswoman decides, that will borrow at a particular price simply because they are confident. So typically what happens is current rates don't matter. What they think, the anticipated interest rates versus the anticipated return from the business. The return from the business has to be higher, and this is how it has to be. In the right hand is the expectation from the business. So from the business, if they are expecting say 12%, they don't mind borrowing at say 8%. Right? So same thing, this is what happens. So this is what will happen. So if interest rates are low, and if let's say interest rates go lower and there is such a big gap, then they will be willing to borrow more and increase interest rates will go up. But if this falls and they are both equal, if I expect to get a 4% return on my real estate investments and my bank deposit is also 4%, or maybe it is 5%, why would I remove my money from the bank and buy real estate? I will not do it, right? So that is what happens, that interest rates are set by RBI at the short end and people's expectation at the higher end. What is the return that I expect from my bank deposit, which is for 10 years? So let us assume for a minute that State Bank of India is willing to pay me 7% return for a 10-year fixed deposit. I would happily give it to them at 7%. But if somebody else comes and says, give me your money, I want to do business with this, and so I would say, okay, very good, show me the risk premium, show me how much extra you're paying. He says, oh, I'll pay you 6.75. There is no way in hell I would give money to that person at 6.75, and State Bank of India is giving me 7% return, right? So that person will have to say, no, we are as good as State Bank of India, we are excellent, we are this group, that group, so we will pay you 7.25. There would be some people who would be willing to part money at 7.25 because they think that this company and RBI are same on risk level. I would wait and say, no, I will not give it to you at 7.25, I will give it to you only at 10, because I want 3% of premium for the risk that I am taking, right? That is the interest rate risk that I am, the capital risk that I am taking. Therefore, you need to incentivize me, you need to pay me a greater rate of interest. That is the signal we send through by not buying a 9% perpetual bond. And we are saying, no, 9 is too low. We agree that it is higher than what I am getting in State Bank of India, but the risk premium that I want is not 2, it's not 3, it is maybe 5. So when State Bank of India is paying me 6%, I want you to pay me 11%. That is the signal we are sending. So we have to keep sending those signals. Then the market will keep increasing the interest rate. They'll say, oh, nobody is buying my bond at 9%. Let me make it 9.15, 9.25, 9.35. And at the same time, if the Tata Group is coming at 9.25, there's a good chance that somebody else who is less reputed will have to pay 10, 11, 12, whatever. This is the time when people have to be careful and not chase yields, saying, oh, that's attractive. It's not attractive. It's like the golden deer which Sita chased. It looks attractive, but when you go there, you will not find it. So be very careful about that. Don't chase yields. This is the third video that I'm doing, and I'm telling people, don't chase yields in a weak market. Many businesses don't have the ability to repay. Even a small restaurant business cannot today repay loans on their original EMI. In fact, many small restaurants are shutting down. I find it's very difficult to travel in this country more because of RT-PCR regulations, etc. So leisure travel is not happening. Business travel has been cut down dramatically. I don't see any entrepreneur wanting to invest by borrowing money today. And if an entrepreneur is investing, you have to do a far greater research as to what he is trying to actually do, or what, if it's it's a doctor who is setting up a bigger hospital or something like that, maybe a good deal. So if it's let's say a lady doctor comes to you and says, I want to set up a hospital just for pregnancies, that would be a great idea. But would people do it today? I don't know whether people are willing to do it today. All these things, the entrepreneur's risk-taking ability, or the doctor wanting to set up a new hospital, or interest rates being very attractive for a big industrialist to put a 10,000 crore project or a 50,000 crore project, whatever it is. All these things determine your interest rate, not just what RBI says. Your expectation of interest rates. If you think interest rates in the future will go down, you will lock yourself into a government bond which is a 10-year bond. But if you're not sure what is going to happen to interest rates 3 months from now, you will be in a floating rate fund. Don't take a 20-year decision based on last 2 months observation. This is what people do. People say, oh, the interest rates are falling, so let me remove money and buy real estate. But real estate is a 20-year decision. Don't take a 20-year decision based on your recency effect. Recency effect is you went to the bank and they said, oh, senior citizen, sir, we are sorry, but we are bringing the interest rate down. Don't assume that the next 20 years this is what is going to happen. So be careful about how to anticipate. So all of us contribute to the information about what should be the interest rates. We refuse to buy a bond at 9% saying, no, you need to give me 11 or whatever. So all these signals determine the interest rate, not just RBI. RBI is an indicator. RBI says this should happen, that should happen. But if RBI tries pushing too hard and comes with 5% 30-year bond, it will not get subscribed, right? So these are all signaling mechanisms, and the market reacts to each one very differently. That's all you can understand about interest rate. So going back to it, interest rates are not decided by a central banker, but it is decided by the market based on demand and supply. So exactly at a time when the State Bank of India is giving you 7%, there is a builder calling you and saying, I will borrow from you at 14%. Maybe he's desperate, maybe he's in a distress, maybe he's not able to get money at rates less than that. This is the time when you have to sit calm and say, I will not chase somebody. I will not be buying that asset when that guy is chasing me and he is doing this kind of a hard pitch. So largely one broad thing, when corporates want to sell paper to you, it's normally the worst time to buy. And when corporates don't do anything, they're lying low and nothing is happening, the mood is somber, that's the best time for you to be buying debt instruments. Thank you.